One decision, two letters, and it determines whether you can legally raise capital or whether the SEC comes knocking. See, in this episode of Making Billions, I'm going to show you the difference between a Regulation D 506B and a 506C offering so that you can determine with your attorney which exemption your fund should use, how much it costs, and how to set it up without making the common mistakes that quietly obliterate first-time fund managers. Let's dive in. Before we go in, nothing in this episode is legal, financial, or investment advice. This is for educational purposes only. You want to always work with your licensed securities attorney for your specific situation. Now let's build. Picture this. You're standing at a fork in the road. Both paths lead to the same destination, raising capital for your investment fund. But they have totally different rules. Break the rules on either path and the SEC can shut down your raise, force you to return investor money, and put your name on a public enforcement letter. That is not a small thing. That is a fund-ending, career-ending, potentially jail time invoking thing. This is very serious. See, I see managers guess at this decision all the time. They pick one, start raising, and 6 months later, they find out they have been doing it all wrong. And by then, they have a mess to clean up that costs $40,000 to $80,000, and that's if it can even be cleaned up at all. So we're going to go deep today. You're going to leave here knowing which path is right for you, what it costs, how long it takes, what kind of marketing plan it requires, and what your attorney needs to review before you even raise a single dollar. Let's dive in. So here's the short version. If you want to raise private capital within the United States, you normally have to register your fund with the SEC. Registration costs can climb past $200,000 and take 6 to 12 months. Nobody wants to raise a fund with that type of time frame. But under Regulation D, that is the legal shortcut. The SEC says if you follow our specific rules, you don't need to register like a public company. And for fund managers, those two rules, they matter more than anything. It's the Rule 506B and Rule 506C. That is it. Regulation D is actually a gift to private fund managers. The SEC created it so that private markets could function without the full weight of public market compliance. You with me so far? Both of these rules let you raise unlimited capital. Both require a Form D filing within 15 days of your first close. Your lawyer will tell you this. But the big difference is who you can raise from and how you can find them. Can you see that? Let's go deep on each one. So let's start with the 506B. I call this one the workhorse. It's the OG of fund formations. It has been around since the early 80s, and it has launched more private funds than any other exemption in history. Most of the funds you admire were built on this rule. It is proven, and it is reliable. And when you use it right, it is clean. So here is the workhorse in plain English. You can raise an unlimited amount of money from an unlimited number of accredited investors. You can bring in up to 35 non-accredited investors just as long as they are sophisticated, meaning they understand the risks. You do not need to verify anyone's accreditation the hard way. A signed questionnaire is enough. That sounds good, right? But here's the catch. And this is the one that burns most managers. You cannot publicly solicit investors. So think about what that means. You start a company and you can't advertise? Yeesh. See, the thing about high finance is this is very network heavy. And so if you have networks that can facilitate at a full raise, let's say $100 million, not many do, but if you can, then maybe this is a good one. It's nice and it's clean. So really what that means is you cannot post on LinkedIn saying, we are accepting LP commitments or interested in investing in our fund, please reach out. You can't do that. You can't send cold emails asking people to invest. You cannot pitch your offering at a public conference to people you do not already know. But what you can do is post just general educational content, market commentary, investment themes, your firm's philosophy or values. The line is this: building your reputation publicly, that's fine. Publicly asking strangers to invest in your fund, that is not. Every investor who actually writes you a check must come through a pre-existing relationship, meaning you knew them before you started raising. Does that make sense? So let's dive into the pre-existing relationship rule. This is where a gray zone lives. I swear I asked 5 attorneys and I get 5 definitions. So again, ask yours because every situation is different. So you really want to make sure that you have this down. If you think with your legal team that a 506B is the right way to go, here's some things to consider. So the SEC defines pre-existing relationship as a relationship established in the ordinary course of business before your offering even began. So that's just saying, I know this person, known them for a long time, knew them before I did the fund. So there was a pre-existing relationship before I started putting my offer into the market. That's it. So this means like a former client, a colleague, business partner, a friend who's known you for years, college roommate. It could be anybody. And if you've been fundraising, you hit up everybody and you try to show them that you're onto something. But that doesn't mean someone you met at a conference 3 months ago. It does not mean someone who liked your LinkedIn post. 90 days before the offering, probably not enough. 3 years of business history? Yeah, that's probably okay. Again, talk to your attorney. But when you're in doubt, you talk to your attorneys and you work out a plan. So you can see this is going into the marketing of your fund. And so I do that a lot, is to say, okay, how do I want to market this? Do I already have people asking me to do it and they'll cut a check? Okay, maybe a 506B with easy onboarding. That's the way to go. If I don't know anybody and I'm jumping into the new-ish waters, then maybe a 506C might be better. We'll get into that in a minute. But I work through that with my attorney for sure. Because if you pitch someone who does not qualify as a pre-existing relationship and you are, in fact, registered under a 506B, you've just engaged in illegal solicitation. Let me say that again. You just engaged in something illegal. Not a great start. And if your entire offering may be non-compliant, every investor has the right to demand their money back. Yikes. You do not want to be in that scenario. So let's illustrate a scenario. So hypothetically, picture a fund manager. Let's call him Marcus. He's running a small private equity shop. He raises his first fund under a 506B. 6 months in, he's short on commitments. He's desperate. He needs to raise money. So he gives a talk at a local real estate conference about his investment strategy. He calls it educational purposes only. It's not a pitch, he says. But 3 people from that talk end up writing checks. 18 months later, an SEC inquiry arrives. Because those 3 investors had no pre-existing relationship with our hypothetical fund manager before that talk, he engaged in general solicitation. Even though he said it's not a pitch, it's not this or that, he still did not pass the pre-existing relationship rule that has to be in place before someone invests. You see where that goes? So he has to return their capital, refile under a 506C going forward, and pays his attorneys $40,000 to $80,000 to clean up that mess. And that's if he gets lucky. Never mind all the sanctions and potential criminal charges that could go against him, if that exists, right? So I'm not an SEC, I'm not an attorney, but it is rough if you break these rules. So this is a foundational rule that you need to get right. So his next fundraise is already delayed 8 to 12 months in this scenario. Now, let's flip it. What if Marcus had simply filed under a 506C before that conference? He could have spoken openly, mentioned the fund, taken business cards, and followed up with literally anyone interested. The total cost difference, the slightly more involved verification process versus 40 to 80,000 and 8 to 12 months of lost time and a ruined reputation and momentum. Or if he truly just wanted to stay under 506B, his attorney could have structured the conference talk with zero mention of accepted capital, keeping it genuinely educational content, and then just reach out only to people he had already built a relationship with beforehand. So if you're thinking about speaking at conferences or building a public profile while raising, talk to your attorney about whether a 506C is a better fit for you, because the cost of getting it wrong under a 506B is far higher than the cost of just filing it correctly from the start. So if you have 20 or more pre-existing relationships with people who already have capital, like former bosses, clients, colleagues, family members, anybody that we mentioned before, you can start there. So this is the foundational move. So you want to build your relationship list first, and then get your attorney to draft a simple accreditation questionnaire. Set up a secure data room for your fund documents, and then raise through warm introductions only. Do not post about it publicly. Do not mention it at events. This is a private conversation, not a public broadcast. And then the pro move, once you have that in place, the pro move under a 506B is you build a structured referral engine. So every current investor introduces you to one new person, but only after you've had prior substantive contact with that person through the investor. Hold quarterly investor update dinners framed as relationship events, not over pitches. Over 24 months, 20 relationships compound into 200. You stay under the 506B and never spend $1 on advertising because your network is the marketing machine. You see how this works? So the pro move is building this system before you even launch your fund. This is why we love attorneys. They help us to navigate a lot of the complexities with the SEC. So let's talk about some of the timelines and costs. So you have a PPM, or private placement memorandum. It's basically sharing with the investor. Here's like a 100-page document that talks about risks. It talks about who's involved. It talks about experience. It talks about our thesis. It covers everything. So the PPM and fund legal setup can be anywhere from $15,000 to $65,000 at minimum for building that fund in a Form D filing. And then with accreditation verification, it's minimal. Investor questionnaires drafted by your attorney. No third-party verification service is needed. So total startup compliance costs can be up to $65,000. Timeline to first close, 60 to 90 days from attorney engagement. And marketing costs are essentially zero because you're not marketing. You're not allowed to market. So that helps you to save a little bit. Now, let's talk about the 506C, or as I like to call the marketing machine. So the 506C came out of the Jobs Act in 2012. I believe that was under Obama, and it changed the private capital world. This is one of the things that I really liked that he did, because for the first time, the SEC could say, now you can publicly advertise your fund. So emerging fund managers rejoice. So if you didn't come from a rich family, or your dad was a fund manager, or whatever it is, you just don't have that capital. Now you have the opportunity to say, well, bright people that may not have the network can still build a fund, and they can advertise and market their offering, but you got to register it properly under a 506C under this example. So let's just think about what that means. Under a 506C, you can post on LinkedIn about your fund. You can run paid ads. You can speak at conferences and talk openly about what you're raising on podcasts. You can email people you've never met, and you can build a brand. You can appear on those podcasts and tell the world that you are raising capital. The walls are down. But there is a real price. Under a 506C, every single investor must be accredited. Not most of them, all of them. And you cannot just take their word for it. You must verify accreditation using an SEC-approved method. No exceptions, and definitely no shortcuts here. So visualize this. So you're raising under a 506C. A college friend comes in, he invests 150 grand, and he says that he's accredited. You skip proper verification because he's your friend, and it feels kind of awkward to ask for that. 6 months later, it turns out his income was not there, and it was not what he claimed it to be. He's not actually accredited. His investment is below the 200,000 self-certification threshold. So a simple signed statement, it was not enough. You needed documentation and third-party verification. You now have a non-accredited investor in a 506C fund with no verification on file. The SEC does not care that you trusted your friend. Your entire offering may be non-compliant. Can you see how that plays out? So here's how verification actually works. So first, let me clarify who counts as an accredited investor. The income test, that's $200,000 a year for an individual, or $300,000 of income if it's combined with a spouse or domestic partner for each of the past 2 years, with a reasonable expectation that they're going to make that in the future as well. So they didn't make it from selling a house. They actually have normal income. Then there's the net worth test. That's $1 million of net worth, excluding your primary residence. So this was the standard definition to say, if you meet that, we need to verify it. And as long as everything checks out, the SEC would consider a person that meets either one. It doesn't have to be both, but as long as it's one of those two examples, either net income or net worth, then you're totally fine. So there is a knowledge-based path added in 2020. So holders of specific FINRA licenses, Series 7, Series 65, or Series 82 automatically qualify. That last one is important, and most people do not know about it. So here is one of the greatest updates that came out about a year ago from the time we've recorded this episode. So in March 2025, the SEC issued a no-action letter that changed the verification game for 506C. And here's what it said. If an investor commits a minimum of $200,000 as an individual or $1 million as a legal entity, they can now simply self-certify their accredited status in writing. Let me say that again. They can now, depending on how much they invest, self-certify the verification. So that got let up, as they're saying, look, if you've got enough money that you can cut a check as $1 million out of your company or 200 grand personally, then the SEC is saying, you know what? You should be somewhat accredited, or we would consider that accredited. So no tax returns, no bank statements, no CPA letter, no third-party service. Just a signed written statement saying they are accredited and that their investment is not funded by a third party for the purpose of making this investment. That's it. That is the massive shift. For fund managers who set their minimum investment at $200,000 or above, this makes a 506C dramatically easier and cheaper to run. For investments below that threshold, the old methods can still apply. Tax returns, brokerage statements, a letter from a CPA or an attorney, or third-party verification like Verify Investor or Invest Ready. So that's around $50 to $300 per investor that you would have to spend to get that. So you can see just by adjusting your minimum investment and actually filling around from people like that, you can avoid all of that. Again, you talk to your attorney and build that plan. So they'll walk you through which path applies to each investor in your fund. So here's a pattern that attorneys will likely see every single week. So let's have a hypothetical fund manager named, we'll call him David. He's running a tech-focused fund. He loves 506c because he wants to publicly talk about what he's building. He files a 506c, starts marketing on LinkedIn, and brings in 22 investors over 18 months. His verification process? He asks everybody to sign a one-page form saying they are accredited. That's it. Several of his investors are putting in 100 or 150,000, far below that $200,000 threshold where self-certification becomes sufficient under those new 2025 SEC guidance. So when a dispute arises over a different matter, an attorney reviewing the fund finds that several investors who signed self-certification forms were below the minimum threshold and were not verified by any SEC-approved method. His entire offering and fund is at risk. And legal fees to cure this problem, probably $85,000 to $100,000, and your investors are likely going to ask for their money back. Now let's flip it. What if David had just simply set his fund minimum at a $200,000 minimum investment threshold, right at that threshold where the SEC's self-certification applies? Every investor can now sign a short written statement confirming they are accredited and that their investment is not third-party finance. So no tax return, no bank statements, and no verification service. So for the costs, the paper, and the attorney's time to draft that one-page letter, problem solved before it ever starts. So if you're raising under a 506c and you want to keep verification simple as possible, talk to your attorney about setting your minimum investment at or above the $200,000 threshold, because a one-page self-certification letter could have saved David $85,000 to $100,000 and two investors walking out the door, and most importantly, his trust that he had worked so hard to earn with his investors. Now, if your warm network has fewer than 20 solid relationships with capital, file a 506c. Build three things before you take your first investor on. 1, a simple fund one-pager reviewed by your attorney. 2, an optimized LinkedIn profile that speaks to your target LP. And 3, a verified verification process through Verify Investor or some of the ones that we mentioned earlier. Do not skip that third one. It is the entire foundation of your compliance. So let's talk about a pro move here.
Hey, if you're finding value out of this discussion, could you do me a huge favor? Could you just take a second and hit that like or subscribe button? It costs you nothing, but it tells the algorithm that this is valuable information, and it helps us to get it to more people. Thank you. You're incredible. Now let's get back to the show.
A pro move is you build a full content and distribution engine. Weekly LinkedIn posts on investment themes, guest appearances on finance and real estate podcasts, targeted paid ads to accredited investor audiences, and build an email list and run a 4-step drip sequence. Introduce yourself, share your thesis, share a deal or case study, and then invite people for a conversation or a webinar. I know a friend of mine, I think she raised $500 million in her first 3 years. That's all she did. She did a strategy of newsletter to webinar, and it was brilliant. And she confided in me and said, after that point, all I really do is when people get on the call after the drip campaign from the newsletter, they're basically asking, what are the wire instructions? So she had that drilled in pretty easy. So under 506c, that works absolutely brilliantly. So then you have your CRM, which could be HubSpot or my favorite, which is ours. It's crm.fundraisecapital.co with 150 or 160,000 investors preloaded. It's brilliant. That tracks every lead from first contact to close. Your attorney reviews every ad and email sequence before it goes live. At scale, this is the only private fund marketing system that helps you compound indefinitely. Now, let's cover timeline and costs. The PPM and fund legal setup can be around $15,000 to $45,000. Let's just say $15,000 to $30,000. Form D filing, it's free as long as you file within 15 days of your first close. And your verification per investor, $50 to $300 if you decide to use that. The marketing system setup might be $5,000 to $15,000 up front. So CRM, ad accounts, monthly content marketing spend, that will also run you around $2,000 to $10,000. So your total first year of compliance and marketing can be $50,000 to $80,000 and maybe 75 to 120 days on a timeline. And then obviously verification, if you're a 506B versus a C, if you still need to verify, that obviously adds time. So you can see under 506C, as long as there's self-verification, they're meeting the minimums, that can speed up your raise and you start turning over investors and moving them into the structure that you and your lawyer set up. So now I want to talk about how to choose which one. So here's how I want you to make this decision. 4 questions and answer them honestly. Number 1, do I have 30 or more genuine pre-existing relationships with accredited investors right now? If it's yes, you may have the foundation for a 506B. Keep going. If no, maybe you and your attorney lean towards a 506C. You need the ability to market what you're offering. Second question, do you want to publicly solicit investors with ads, cold emails, open conference pitch days, social posts, podcasts, you name it? Is that how you want to get your market to realize what you're offering? If the word is yes, you must use 506C. There's no workaround here. If the answer is no, either works. But no, posting general education content is fine under a 506B. It is the solicitation of investment from strangers that is not. Once you have that, then you continue to question 3, which is, do you have sophisticated but non-accredited investors that you also want to include? So some people, they're like, I want to take care of my mom. She's taken care of me for so long. Whatever it is, maybe they're not accredited. If the answer is yes, again, maybe 506B is your option that you pursue with your attorney. 506C does not allow any non-accredited investors to join. If the answer is no, either works, and you move to question 4. And that question is, what is your 5-year vision for the fund? Are you building a fund brand beyond your immediate network? Then maybe you consider 506C. If not, then you can just do a 506B. So let's talk about relationship-based growth through a trusted network. 506B can serve you for multiple funds. The default recommendation is first fund is a strong network of at least 30 plus relationships of check writers that can fill your round. And if you have that, then maybe a 506B. First fund, thin network, then maybe a 506C. Second fund, 506C almost always, because now you have a track record that is worth marketing. And switching between funds is completely legal. Your first fund stays under whatever you filed, and your next fund can use a different exemption. It's totally fine. So here's what your attorney needs to review, and this is non-negotiable. Before you raise a single dollar, your attorney needs eyes on specific things. So let me walk you through exactly what to review so you can understand what it looks like and what it costs. So under a 506B, your entire investor communication strategy, let's cover that first. Every email template you plan to use, every presentation you plan to give, your attorney is looking for language that could be interpreted explicitly or implicitly as a general solicitation. Even language like, I'm excited to share an investment opportunity, even though you didn't say that you should invest in. You just say, I'm excited to share an investment opportunity sent to someone you do not have a solid pre-existing relationship with could be a very big problem for you down the road. Second, your pre-existing relationship documentation process. So how are you logging who you know? When you meet, how long you've had that relationship? Your attorney will help you build a simple relationship log that protects you if the SEC ever comes knocking. Third, your accreditation questionnaire. This is the document investors sign confirming their accreditation status. Your attorney drafts it, investors sign it, and you keep it in your files forever. So under a 506C, here's the attorney checklist that you may want to go through, among other things. So first, every single marketing asset needs to get reviewed before it goes live. Every LinkedIn post template, every ad copy, every email drip sequence, your attorney is looking for anything that misrepresents your fund, makes performance claims without proper disclaimers, or targets non-accredited investor audiences. Second, your verification process. Your attorney confirms that your chosen verification process meets SEC standards. They review your service agreement with your verification provider. Third, your investor intake process. When does verification happen relative to when you accept the commitment? The SEC wants verification before or during your raise with an acceptance, not after. So what does something like that cost? Well, the budget can be around $500 to $2,000 for an initial compliance review of your communications strategy and your templates. After that, build in 30 minutes a quarter with your attorney to review any new marketing materials. That's, $500 to $1,000 per quarter compared to the $40,000 to $85,000 of cleanup costs we mentioned earlier. This is the cheapest insurance you will ever buy. So let's talk about 4 of the common compliance mistakes that end funds. Mistake number 1, the accidental general solicitation. We kind of talked about that, so let's really drill this down because I want to keep you guys safe, raising capital and building great businesses. So you're under a 506B, you get excited and post on LinkedIn, excited to announce we're accepting limited partner commitments. Reach out if you're interested. That one post, that's a public solicitation. It makes your entire raise potentially non-compliant. That rule is not that you can't post on LinkedIn at all. General educational content about markets or your investment philosophy, it's typically fine. The rule is that you cannot publicly ask people you do not already have a relationship to invest in your fund. You can't even suggest that that's a possibility. One solicitation post, one cold pitch at a conference, one press release announcing your raise, call your attorney before you say anything public that could be read as an invitation to invest. Now, mistake number 2, the skipped verification. You're under a 506B and you skip verification for someone who obviously qualifies. Don't do it. Verify everybody. The SEC's examination staff looks at verification records first because it's the most common violation in a 506B offering. There are no exceptions. Your best friend who works in finance, your brother-in-law who owns a business, verify them all. That takes us to mistake number 3, the gray zone relationship. So in this scenario, you met someone at a conference 3 months ago. You've emailed twice, and now you want to pitch them under a 506B. The SEC standard is a relationship established in the ordinary course of business way before the offering even began. A conference meeting 90 days ago, it could be a gray zone for you. Either get your attorney to review your specific situation and give you a clear yes or no, or do not include them in your offering for this raise. One borderline investor is not worth losing your safe harbor. That brings us to mistake number 4, documentation. Whatever exemption you use, documentation is what protects you. Under 506B, keep a log of every pre-existing relationship, how you know them, when you met, how the introduction happened. Under 506C, keep every verification document, even if it's that one page where they sign off, keep it all. Every third-party verification confirmation needs to be held and filed. If the SEC ever reviews your fund, your documentation is the difference between a clean audit and a total nightmare. Build the documentation habit from day one. Now let's talk about your marketing plan that's built around your exemption. So the 506B marketing plan goes something like this. Your entire marketing operation is built on relationship depth, not marketing reach. So here's what a 90-day plan looks like. Month 1, audit your relationships. Build a list of at least 50 names of people that you have a genuine pre-existing relationship with. Name, how do you know them? How long? Last contact date. You got to be thorough, but this is what helps you to avoid any SEC audit nightmares. This is your legal fundraising universe. Then month 2, reach out personally to your top 20 most likely yes contacts. Have a coffee, go on phone calls, one-on-one meetings, not mass emails. Then month 3, hold your first investor update dinner. Existing warm contacts bring one guest each, someone they know personally. You now have expanded your universe legally under a 506B. The 506B marketing plan is slower than a 506C, but relationships you build are deeper and long-lasting. Investors come through warm introductions, stay in your fund longer, refer more, and cause fewer problems. Why? Because you've built the trust before the transaction. And if you've been following me for a while, you know that that is absolutely key. Now, under a 506C marketing plan, if this is where you're at, your marketing operation has 4 channels working in parallel. Channel 1, content. Weekly LinkedIn posts on investment themes, market insights, and fund relevant education. No direct fund promotion in organic content. Just build credibility. Channel 2, media. Podcast appearances, guest articles, speaking slots at conferences where you can openly discuss your fund. And there's channel 3, paid outreach. Targeted LinkedIn ads and email campaigns to accredited investor lists. Your attorney reviews every ad and email before it goes live. And then there's channel 4, referrals. Even under a 506C, warm referrals close faster and at higher conviction. So build a formal referral ask process into your investor onboarding process. This is what I do at a couple of the funds that we're standing up at Darkside and Acor. We're building that into our onboarding process. The 506B marketing plan requires real investment, time, money, and systems, but it has no ceiling. Your 506B raise tops out when you run out of pre-existing relationships. But your 506C, that raise tops out only when the market runs out of accredited investors who can match your thesis. You see the difference in scale? So here's your 72-hour action plan. 5 moves this week, not next quarter. Move number 1, decide your exemption. Answer the 4 questions I just walked you through. Write your answer, 506B or 506C, on a sticky note and put it where you can see it. This decision will shape everything that follows. Then there's move number 2. Engage a securities attorney who specializes in Reg D offerings. Not a generalist, not a friend who passed the bar, a securities attorney who has filed at least a dozen, if not 120 or more offerings. Get those referrals from other fund managers in your network. Budget $30,000 to $45,000 for your PPM and fund stand-up. This is not optional. This is foundational. That brings you to move number 3. Build your infrastructure based on your exemption. Under 506B, build your pre-existing relationship log. 50 names minimum. Name, relationship, how long, last contact. This is your legal fundraising universe. And then under 506C, research and select a verification service. Sign up for a free trial on whatever CRM that you decide to use before you need it. Then there's move number 4 is set your Form D calendar for the reminder. The moment you accept your first dollar, the 15-day clock starts. Your attorney files the Form D. Missing this window can cost you your safe harbor. Set the reminder the day before you even take a check. Then move 5, write your 90-day marketing plan. Again, if you're a 506B, 10 relationship dinners or calls in the next 90 days. No cold emails, no ads, pure, warm relationship harvesting. If you're a 506C, optimize your LinkedIn profile by the end of the week. Select your verification service, have your attorney review your first email sequence, post your first piece of educational content. I did this over 4 years ago. So here's what I want you to sit with as we wind down this episode. In version 1, you guess at this decision. You pick an exemption, start raising, and 6 months later, your attorney sends you a panicked email about general solicitation violations or skipped verifications. You spend $40,000, $80,000 on a legal cure. Your raise is delayed 6 months. Some investors even pull out because they have lost confidence in your ability to lead. You start over with less money, less momentum, and less trust than when you started. But in version 2, you made this decision right from day 1. You picked the right exemption for your network and your ambition. Your marketing plan was built around exemption rules. Your attorney reviewed every piece of communication before it went live. Your documentation was clean from the first investor to the last. You raised capital confidently because you knew you were doing it right. Every dollar you raised stayed raised. Version 2 does not require more talent than version 1. It does not require more money. It requires that you understand this framework I just taught you. Make the right call and then execute with discipline. That's it. The fund managers who win in this game are not the ones who got lucky. They're the ones who built their raises on a solid foundation and did not spend years clawing out preventable mistakes. That foundation starts with getting Reg D right today. Not next month, not after your first close. Get it right today. So if you want to get the playbook that goes into this episode, it has the full decision flowchart, cost comparison, and compliance documentation checklists. The link is in the description in the notes. You do these things and you too will be well on your way in your pursuit of making billions.